All right, time to break it all down with Matt Shapiro, president of MWS Capital from the CBOE, and back with us from our 2011 Reveal Stock Market panel, Steve Kroll has been nice enough to stick around. He's managing director at Monness Crespi Hardt. Steve, by the way, has been in finance for more than 4 decades and currently advises the top institutional investors in the world. And Matt, I'm actually going to kick it off with you. We're coming off our highs, but we're not too much in terms of changes. But the volume is what really catches my attention all week. But no surprise that volume is so down. Between the weather and that it's just being a holiday week here?
Well, it is. Remember the last couple of years, and this is something I've been hammering this last couple of weeks. These quiet sessions are, for me, a very bullish confirmation signal that the market has reached these levels and we're going to go higher in 2011. And you agree?
Yes.
I know you do. despite maybe the macroeconomic picture.
Despite the macro.
Despite those concerns.
Which is very nerve-wracking, but I think the market's going to be okay.
There's nothing that could change your mind. I mean, there's a lot of issues we didn't even get to when we talk about the municipal bond market. I mean, Julie was just talking about, Meredith Whitney coming out and talking about what's going on. You don't think any of that could disrupt kind of the optimism in the equity trade?
Of course, there's always bumps in the road, but take a look at...
But more than a bump, Steve.
Well, I mean, I'm very nervous about the sovereign debt. That's a big issue here and in other countries. I think we're going to lose our AAA credit rating, which we talked about before, by June. But we buy stocks and we recommend stocks, and I think there are a lot of good stocks out there. We can have a good correction.
Wait, how does the U.S. losing its AAA credit rating not result in a huge flight from U.S. stocks?
Well, because I don't buy U.S. debt.
Right, but even if you don't buy U.S. debt, does that not cause a questioning or reassessment of the whole foundation of the U.S. economy and people to pull their money out of U.S. stocks?
Well, no, I think what's happening is people that buy U.S. debt want a higher rate right now because they don't think it's as creditworthy as it was before. There's no doubt it's the greatest country in the world, but if you look at the statistical numbers for the deficit as a percent of GDP, we're off the charts. And Obama 1 week says he wants to cut spending, and the next week we raise the deficit by $1 trillion. That's not good. So I think the U.S. debt should sell at a single or a AA credit rating. We will get through that. I think the market's figuring that out very quickly. But, Microsoft and a lot of Cisco, these are AAA credits. I happen to think that the Treasury market will back up and almost equal what corporates are selling at because corporates are a better investment in terms of the
less
liquidity.
Risky than U.S. government debt.
Well, we can always print our way out of it, but we have not. We've taken steps to print. We haven't taken steps to cut spending. That's why on our earlier segment, I would have much rather had a lot of these slight tax increases across the board rather than keep doing these deficit spendings. That's just my point of view.
And Steve, I got to tell you, somebody in here is emailing me, one of our viewers, and said, this guy is on drugs. I mean, they don't buy. But Matt, let me bring you in.
Too much eggnog, Steve.
Matt, I mean, if we get our AAA rating is cut here in the United States, don't you think that's going to create tremendous tremors through global markets?
It will, and I think temporarily, although I do not see that happening this year. However, I have argued for a while now that we're entering this Blade Runner financial world where the credit of individual corporations, for instance Cisco and Microsoft, will be as good as the United States. Finally, let me say that the root of the European financial crisis was not that they had borrowed too much, is that people were mislaying the rates, i.e. lending to Spain, Portugal, and Ireland at way too low rates. For instance, for me in the U.S. municipal market, I'm a big investor, and I gladly lend to California and Illinois because the rates show the risk there. For instance, I've lent to both states at about 7.5% over 20 years. I think that's a good number that shows the risk to their budget, so I feel comfortable there. However, I would not lend to a European second-tier country at 4% and 5%, and that's where people got in trouble.
Hey, so let's go back to stocks then. Given the rally that we've had this month, do U.S. stock prices reflect the risk that could be out there? The risk of sovereign debt bleed over, for example, or the risk that the housing market woes will persist? Some of the risks that we talked about with Steve a little bit earlier in the show.
Well, I think one of the problems with the United States over the next 5 or 10 years is, of course, the debt. And we're really not going to do anything about it because the constituency of voters will not cut their entitlements. However, the attractive valuations and the dividends paid by big blue chip stocks and their profitability cannot be ignored. And one thing I'm looking for in 2011 is the small caps to continue to do very, very well. It hasn't really been talked about, but realize in 2010, your basic small cap fund was up 25 or 30%. And I think in 2011, that's going to continue.
You know, Adam, I want to bring you into this because you're taking a look at the small caps and the outperformance that we've seen.
Yeah, sure am, Carol. This is one of the most requested charts over at Strategas Partners from all their clients. They wanted to look at small cap versus large cap. Matt, you're going to love this one. All right, Steve, I'll be curious to get your input as well. All right, this is small cap versus large cap relative price performance going back to 1980. And look at where we are here, guys. This is about a 25-year high. In other words, small caps starting to outperform versus the large caps. That speaks to breadth, speaks to people putting on risk. They're willing to buy small caps rather than large caps. Matt, is this what you're talking about, people going out on the risk spectrum?
It really is, and it shows you that this small individual investor is going to come back into the market as these macro issues recede, at least for the short term. And one thing I want to say about small caps, since 2007, their volatility was rising rapidly, and I kind of got them out of my portfolios, except for some real reliable ones. But going forward this next year, I'm going to study them real hard and add to my holdings in them. Remember, there's 600 stocks in that small cap index that was up 25–30%. So there's a lot of potential in these $1 billion names, especially as the large corporations get money off their balance sheets and put it to work.
You still like, though, or your guys, your research guys, still like a lot of the large cap names.
We do, but along the lines of what he was just, Adam was just saying, the small caps are going to have more revenue growth than some of the bigger companies that have reached their peak. So I don't think that's that's out of the normal what you saw there in terms of the performance. I think that's, some of the big companies, telephone is just not going to grow 15% a year.
Right.
Where
it's probably getting more yield from some.
Right. They're much
don't go to small caps for yield, for example.
And you're seeing that in the market this year, and I think that's probably going to continue. But that goes back to one of our comments that we made earlier, that we think this year you're going to see a lot of acquisitions because some of the companies are going to buy other companies to get the top line growth, which they can't get from just general business conditions.
Now, let me just connect the dots and kind of talk this thing through. Were there to be some sort of downgrade for corporate bonds or for the U.S. bonds, you could imagine corporate bonds obviously having to move down, and typically higher rates are not good for small caps. So as we sort of talk this through, is there a flip side argument to not wanting to be in small caps?
Well, I mean, they're up 20-some-odd% off the bottom, so there's nothing wrong with having a pullback or a correction. But I don't want anyone to get too hung up on the AAA credit. Take away, we're the greatest country in the world.
In other words, maybe that's a 1 in 3 shot.
No, I think it's 100%. I mean, that's my opinion.
But you're saying it's not as negative as it sounds.
I think the market's figuring it out very quickly. Just take the numbers.
But
we have a $3 trillion.
But still, the market thinking about it, and it actually happened. That's a huge headline.
I think, first of all, that we're talking about it here, and we've talked about it now for almost 6 months to a year. Just look at the numbers. Anybody gets up in the paper and sees a $3 trillion budget deficit, a lot of off-balance sheet financing, versus 1991 we had a budget surplus. And if you don't think there should be some change in our rating, then we're going back to the same rating problems that we had in 2008.
Right.
I say it's not a AAA credit. That's just my opinion. I say it's a single or a AA. That's just from the numbers. We have the best country. We can print money, and we have the best army, and it's the greatest place in the world to live. But it's not a AAA credit, period. Now, in terms of stocks, there's plenty of stocks out there. That may provide you the great opportunity to buy some more names under pressure. Right. On that day, you can get a 5%.
Words, all the money that has been sloshing into bonds over the past 18 months, now all of a sudden it says, wait a minute.
Correct.
Prices are going down. I'm going to reallocate and go to stocks.
Correct.
But
I think that's what you've seen the last quarter.
I mean, Matt, is that really going to happen? So many folks still sitting on the sidelines. The retail investor is still kind of freaked out from the financial crisis and the fallout. What really brings it back, and does it truly, truly happen en masse in 2011?
Well, I think it will. I just had an investor email me, saw me on TV. He put his money into a very conservative stock and bond fund that's done okay for him, but he's probably ready to trick it out a little bit, go into some small caps, add some emerging markets, and I think you'll see the individual investor do that. All that money flowing into those riskier ETFs is going to support those individual companies.
Tricking out your portfolio, that's going to be a new term going forward. I like that for 2011. All right, guys, we have to leave it there. Matt Shapiro, thank you so much. Happy New Year to you. Steve Kroll, as always, thank you so much.